Daniel, Gen Wealth Concepts. Wanted to kind of touch on a subject that I see a bit online. I see people talk about, they compare the different types of policy design. I don't talk about policy design a lot, but policy design is going to depend on how large of a base premium you do on a policy, and most of that's going to depend on the client's needs. If they're real estate investors, they're probably going to do a smaller one because they want to maximize the amount of cash that they can pull out right away and put that money to work in their real estate investments. So that's just an example, right? That could be for a lot of different situations. But then the other people who might be using it for, say, retirement, they might want to pay a higher base premium just for the simple fact that with a lot of companies, you are looking at, you get better treatment as far as dividend treatment. They'll pay you more dividends on the base policy. So on the base premium, it is one of those situations where if you're doing the be your own banker type of concept, the idea is you fund it for 10 years and then the paid up additional insurance, paid up additions drops down significantly. So say if you do it the traditional 40% base, 60% paid up additions, which is the way that, the original concept started, is that they're paying you more dividends on that 40%. So you're paying, 3x that base premium into paid up additions. And then after the 10th year in year 11, you're 1-to-1. So if you pay $5,000 a year in base premium, you can pay up to $5,000 a year in actual paid up additions. So what a lot of people will do is rather than pay that extra $5,000 into the paid up additions, they'll keep paying the $5,000 because they know they're getting a nice amount of return on that $5,000 in the base premium going forward. And then they've started additional policies to where they're paying the full amount, funding it again, and so on. And so when they get to where they're much older and they're only paying base premium, and these base premiums throwing off a good amount of dividends, they're going to find a way to pay that when they get older. And even then, you can do a premium offset once you get older, and it'll come from cash value as a loan, or even you can just have it, your dividends pay it in some cases. So the dividends you're getting, it'll come out of your dividends and you'll still have a surplus and it'll keep going. So there's ways to offset that premium later. It comes out differently, and it comes out differently in the way that, it depends what you're trying to accomplish, I really think. And two, compare one with a very low base premium and pay the full amount for many years, and then pay the full amount on the other one for however many years. It's not going to be the same because you're paying all the paid up additions. Now, if it's the same amount of money and you're maxing both out for a number of years, yeah, maybe. But the general concept of being your own banker is not to necessarily max out those paid up additions, even though I always recommend to do it. If you have a surplus of cash at any time, it is worth your while because that's just putting more money into the policy. It's going to get a return regardless. So you're going to get dividends on that money. And then it's a larger amount. Even if you borrow the money back, it's a larger amount that you're working with that they're going to credit dividends to. So I max out all of mine, but I also haven't started. I'm starting some this year, but one on each one of my family members. But I hadn't had any new ones in probably a few years. So, and mind you, it might even been longer than that. Yeah, it's probably been a few years. Anyway, I max them out. I put as much of my income as I can into what I have available to pump into those policies. And it's not a strategy for everybody, because my strategy is put as much of my income into that first. And if I could get all of it, I would, because it's going to be, there's going to be a huge difference in what I'm getting paid in, say, 10 years, what I'm receiving from dividends. So it's, for me, if I could put every bit of my income into premium, and that's basically what, Nelson Nash, that's the general thought process, is at some point your income should equal the premium you're paying, or I'm sorry, I said that backward. Your premium should equal your income. That's hard to do, especially if your income increases every year, and it should. For the most part, it should. I mean, there's inflation and whatnot, and if you're living on the same amount of money, that's kind of rough. But you're still, and then going back and just borrowing what I need to live on, I don't mind having loans. And then if I have it all maxed out, then once I'm maxed out, I'll start paying the loans back, and there'll be payments every month of whatever those expenses would have, could have added up to, or whatever. But of course I would borrow, enough for discretionary money and whatever. But my point being is that even though that money is borrowed out, even though that's decreased the death benefit and the available cash value, they're still crediting you on the full cash value amount. So it's going to be in your benefit. And in the later years, the interest is not even going to mean anything, really. It's hard. Well, let me say, depending on how it's structured, it's hard for one to be completely upside down in the later years on a policy. Hence the reason why somebody's able to take a loan for income year after year. I'm probably going to do a video. I'm going to illustrate, a retirement type of situation where somebody did basically the same amount. I guess it's $6,000. Is kind of the average. If you're maxing out, say, like a Roth, and that changes a little bit and whatever based on age, but let's just say it's just an easy $6,000 a year. And, you pay into it for, I'll do it for like 20 years. And then I'll go and show, later on, if they do this when they're in their 30s or 40s, or maybe start at 40, that might be a fair number. They pay into it for 20 years and then show what they can start pulling out and for how long, just to get an idea of what a tax-free life insurance, and I should say, let me say tax-advantaged life insurance retirement plan would look like. But anyway, getting back to the subject, they're comparing the different policy structures. It's tough, because if you were just doing the become your own banker type situation, if you had a very small base, or as small a base as you can get with the insurance companies, and it's $2,000, but somebody else's base is $8,000, and you actually just pay those going forward, the comparison isn't there, because you're paying more into base premium. And if it's with the same company, same treatment of dividends on that base premium, of course you're going to come out ahead with a higher base premium, where if it's 10% as opposed to 40, there's not I think there's a time and place for both. Really do. Everybody has a different situation. And if you're just talking about just cash value and you're going to cram that same amount in every year into one policy for the rest of your life or whatever it is, and mind you, it's got to be the right company for you to be able to do that. Most companies, you can only do it for, say, 20 years, and maybe a little bit longer, or it might have to reduce a little bit after a certain point. Really depends on the insurance company, whether or not you can pay in long term with a super small base premium. But if you're going to do that, yeah, it's going to come out probably. It's probably going to come out better. I mean, but you can't. It's hard to sit there and go just strictly off of an illustration, because an illustration in insurance is the equivalent of a prospectus in an investment. It's a projection. It is not. They don't have a crystal ball. The flip side is with insurance, I can say my experience is it's either been on the money, slightly under, or far ahead in some cases of the actual illustrations. I've had some outperform, I've had some perform right on the money, and I've had some slightly underperform. When I say slightly, it's a couple $100 off, which is still, in my opinion, pretty amazing, because it's still on target. And depending on the year and how well the insurance company does and what they declare as a dividend to the policyholders or the shareholders, which is the policyholders, will depend on what you get. So for those of you that fight constantly over which structure is better, I say it depends. Depends on the situation, and depends on the client. What do you want? What are you looking for? What are you trying to accomplish with it? Anyway, please like, subscribe, click the little bell. Leave any comments down below, questions on any of this. Whatever you want to leave down there as far as messages for me. And if you want to see content, please do that as well. I try to come up with new stuff, and I try to provide value. So you guys have a great day.